You know what? I was going to do good morning, good evening, good night, but Mike apparently doesn't like it. So I'll just say hello, everyone. Hello, Layer 1 community. What is going on? It is another Layer 1 Live episode. We are coming to you on a beautiful Monday. It is 1:32 p.m. and we are coming to you live. So we appreciate everybody following along that is jumping in immediately. We've got a good episode today. Mike is chugging coffee. Dimitri is getting the coconut water in, so we're all doing a little bit different things here today. So what is going on, fellas? What's happening?
Not much, not much. I don't hate. I like the good morning, good evening, or good afternoon. However it goes. I can't remember.
Doesn't
But
even know it.
yeah, I don't even know it. But that's how I know. That's how I know we're going live. So yeah, I don't mind it. But yeah, things are good. Springtime's rolling over here in Pittsburgh. Like you said, I'm chugging some coffee, feeling a little tired this morning. So Dima, keep me moving here.
Yeah, no, absolutely. I like how you skip the afternoon. You say good morning, good evening, good night. Like there's no afternoon. You know.
What's the evening? What's the evening? Come on, it's the same thing.
Yeah. So yeah, I agree with Mike. The weather is pretty nice here in Pittsburgh. Too bad you can't really go anywhere because of quarantine, obviously. But yeah.
Nothing like a good Pittsburgh summer, man. Nothing above 90 degrees. Staying in the 80s, maybe even 70s, man. I do miss it. So we got a couple things to get to, guys, before we go into breaking and go into news. Kieran's in the chat, Manuel's in the chat. What's going on, fellas? Good to have you this week. You guys missed us talking about Mike's coffee, but that's about it. So we're gonna talk about. Let me pull up the stats here, but we do have that Telegram group, guys. Obviously, we made some announcements here on Layer1Live as well as in the Telegram, but we are moving Telegram groups. So we kind of made an announcement in Telly saying, hey, you need to reply to this poll and see who's active, because what we really want to do with this Telegram group is have a little bit more active membership role, and also kind of like an invite only kind of way going forward. And we do want that Layer1 t.me as well. That was kind of one of the reasons. So for all these reasons, we are moving Telegram groups. So hey, what's going on, Meta? Scott's in the chat. Guys, you are filling in, but we will be making that group change today. So if you haven't got over to the Telegram group, do so now and make sure that you're messaging there so that I know and we know to move you over to that new t.me / whatever it will be called, Layer1 pod, things like that. So other than that, let me get the stats out. Guys, do you have any filler while I did get this?
Interesting episode here today. I'm excited to hear about this Iran news from Deem, some hyperinflation happening there. That's one thing that everybody's always pitching, but we've got some little bit of recap on Bitcoin and the price moving up here. We got some interesting news from Vitalik and some of the things he's been saying. Obviously, some EOS news in there, and we're going to talk a bit about Genesis and kind of the lending market. So it's going to be a good episode.
Yeah, definitely a good episode. They were giving me some hell for the amount of EOS news that I've got in the chat. So I'll make sure to keep those low. Unless you guys want to just have an EOS episode, we could like call it everything something EOS. So you can but anyways, let me get to the stats real quick, guys. We got USA, Germany, UK, Australia, and Canada. So we appreciate everybody overseas listening to us, as well as the people in the US. Thanks for stopping by. Top 3 episodes, we had DeFi rates, obviously already killing it. We had them on, I believe, on Friday, and we released the episode on Sunday. They were really, really cool guys to talk to as far as the DeFi space and what they're trying to do, aggregating all these resources and information. Orchid is coming in at second. We had Dr. Stephen Waterhouse talk about Orchid, which does like a crypto-powered VPN, and then Alex Masmej with that ICO Alex token, interesting guy within the Ethereum space. So other than that, upcoming guests, props this week, staking facilities this week, and OpenSea, that NFT marketplace as well. So that's the lineup. As you can see to my, I guess, stage right, it is breaking discussion, Bitcoin, Ethereum, EOS, and Ripple today. That's pretty much all the housekeeping we've got. I know we wanted Dima to hit the billions talk before we got into breaking.
Yeah, no spoilers alert, obviously, for Mike, because and for anybody else who didn't watch the new Billions episode, it was fantastic. Like I was very excited to see how they're still keeping the show going with the same momentum. It was great. Obviously, everybody saw the mention of Bitcoin there. And we've seen, in billions in the past, and on that show, they've mentioned crypto before many times. So it's pretty cool.
What was the actual reference to Bitcoin in the episode for those of you that didn't catch it? I would love to know.
Yeah, it was just basically Chuck Rose, which is one of the main characters. He was like saying, hey, what is this, Bitcoin, like, it's not backed by anything. And then they're like, well, fiat is not backed by anything, So
Classic.
Yeah.
Nice, man. Well, let's get to breaking news. That is a good reference. I know Mike tweeted about billions this morning too. So we're seeing a little bit extra crypto adoption, huh?
Yeah, I think it's now that the crypto has kind of reached a certain level of adoption, or at least interest, a lot of these media and entertainment companies or shows or whatever are realizing, like, hey, if I literally throw in a 30-second soundbite about this, even if it doesn't make sense, it's going to blow up on Twitter and the old crypto Twitter community. So, it's
marketing.
Hashtag marketing, right? when moon kind of deal. But anyway, let's hop right into it here. I've got the first breaking story. It came out here this morning at about 10:30 Eastern that according to the Block, Ripple is using what they're calling incentives to pay Moneygram to basically increase the liquidity that exists on Ripple's kind of interbank network. We're going to talk a bit about this towards the end of the episode, but Ripple is one that, hasn't really had a lot of steam as of late. If you remember back in the day, years ago, they were one that had kind of the Ripple Army or whatnot. I know you have the Link Marines. I think it was the XRP Army.
XRP.
Is the hashtag that was going around, but we haven't really seen that as of late. And obviously Ripple has been dumping a lot of XRP on the market. So some interesting news there on Ripple's front.
Yeah, man. Some comments in chat about Q's haircut. See, I told you it does look good.
Guys, I did this myself, man. I got my girlfriend to a little edge up the back a little bit, but I was like 1 down low, 2 on the medium. I learned from the best, Red, one of the best barbers in all of Pittsburgh area. Learned myself, so boom, got it done.
I'm waiting for you to visit here so you can give me a haircut. As you can see, my hair doesn't look that good. Anyway, moving right along. So the next piece of news that came out today was Iran ditching the Rial, aiming hyperinflation. And it's kind of similar to the story that we've seen in the past, where from LocalBitcoins, basically, where Bitcoin is trading at the heavy premium against Rial, because there's a huge demand for it. Today we're seeing that again, reports of Bitcoin being bought from LocalBitcoin at a heavy premium, where it's basically translates to like 34,500 per Bitcoin in terms of Rial if you do the conversions. So it's something that I've been talked about for many already many days about the on-ramps for these countries that are going to be struggling economically. And LocalBitcoin is definitely not the best on-ramp, because as you can see, the people that get into Bitcoin, they're paying a ridiculous markup on BTC, but that's the only way they can actually go about acquiring BTC. Now, the reason why this is happening now with Iran is because they just passed reforming monetary and banking law. So because of the sanctions and things that are going on economically, with Iran, they're facing hyperinflation with their Rial, and now they're coming out with this token, which is going to be valued at 10,000 Rials. So it's just kind of like spinning up another token here that's going to, basically equal to an X amount of the other token, which is the Rial cryptocurrency. The Rial real currency, fiat currency. So basically it's their kind of way to battle the issues that are going on, and they're obviously going to put in restrictions and so on. So Iranian people, they see this happening, and they're obviously not trusting the government, and that's therefore we see this demand for BTC from Iran, where they're willing to pay a pretty significant premium for BTC. One thing that I want to mention though, I would love to see the volume that's transacting at those prices. I think that would be a pretty big tell, because last time we had the volume that came through at the premium prices was, I don't know, it was like 100K in dollars. It's really not that much,
Yeah, we've been talking about a lot of macro, global, and political events here over the past month or two. It seems to be all trending in a certain direction for Bitcoin, at least from like a user adoption standpoint. So that's some good news. I do want to highlight the chat. The chat is lit this morning. I'll tell you what. We've got Kieran in here saying RIP Telegram group. There is, as like one dies, another rises, Kieran. So we will have that other Telegram group. Meta's asking about how to get access. We will drop that in the Telegram group here. But basically, if you're active in that Tele group, you're going to get the invite to the new one. If you want to leave a comment on this YouTube video as well and get an invite, just let me know. Just throw your Telegram at there, and I'll make sure to do so. Andre from Incognito is in the chat here this morning. He was in the Layer1 chat when we dropped the link to the video this morning, and we're going to talk about privacy within DeFi and on Ethereum, which the Incognito team is actually doing. So Andre, good to have you in the chat. Hopefully we don't say anything stupid. If we do, point it out to us. Other than that, Kieran's talking about USD and that Billions episode, and that's about it, man. We're rolling into breaking news here. The first piece of news, guys, is going to be that DEX volume on Ethereum has really ramped up, especially over the past 3 months. This had a lot to do with all the events in March, but basically this was data analytics collected by Dune Analytics, and then posted by Anthony Sassano. It said total DEX USD volume for all of 2019 was 2.4 billion. Now, all of the DEX volume for 2020 up to this point, so barely 5 months, just basically 4, we have 2 billion already. So that's a lot of uptick in volume. I'll drop the link in the chat here so that you guys could follow along. But basically, man, that's just DEX volume, and they highlighted some DEXs. Obviously, IDEX is in there. Uniswap was a big one that saw an uptick in volume and market cap over that March preceding with that Black Thursday event. But Kyber was mentioned as well. So it looks like just a huge uptick in volume, man, on these DEXs. Hopefully, we continue to see DEXs being built out over the coming months.
Yeah, it's been impressive to see the growth on DEXs, Uniswap, Kyber, a handful of them. So yeah, it's good to see, right? I'm glad the decentralized exchange space didn't kind of just completely fall off the map as centralized exchanges were really at one time just taking more and more market share.
Yeah, absolutely. And I'm really like buying into this aspect of composability on Ethereum. As everything gets built out, it's like a self-fulfilling prophecy, man. Everything's just, you can do so many things within Ethereum at this point. But this is quick news, so we'll do it quick. Binance obviously launched that smart chain white paper. They unveiled it to the community, and in a shocking turn of events, people are upset at the Binance Smart Chain white paper. Really shocked here. I don't know if you can sense my sarcasm, but basically people are saying that the top 21 is going to be governed centrally. CZ is going to have a ton of control in this DPoS system because of the tokens that he has, as well as it being like kind of I think Masari called him out for just outright copying the smart contract platforms that have already existed. EOS, to really be specific here, they're running kind of a DPoS system with 21 block producers as the main kind of group there that's handling the governance. So a ton of kind of, I guess, blowback to this white paper from the community. We'll see what Binance can do if they can kind of bootstrap this with their own community. I don't think they're going to be pulling from Ethereum or EOS anytime soon, so they'll have to kind of bootstrap that community themselves.
Yeah, it's going to be super interesting to see how that continues to survive. But we've definitely talked about Binance Smart Chain and how it's like, instead of using somebody else's DPoS system, want to just build your own. But one rollback. Anyway, moving forward, so more than 77% of total ETH not locked in a smart contract hasn't moved in 6 months. So there's data that came out from Glassnode, basically saying that ETH holders are hodling, and 77.7%, basically of that ETH hasn't moved. It's ETH that's actually located on external, what they call externally owned accounts, which is accounts that hold their own private keys. So it's pretty interesting to see, how majority of it is hodling. But one thing that my question about this is that could it be exchanges also including that data as well, holding the ETH on external hardware wallet, and basically not moving it because they just hold it for collateral or whatnot, right? So that's one thing that's kind of not clear here, but interesting piece of news. The next one is miners are mining very quickly in anticipation of the halving drop in BTC rewards. So this one is pretty straightforward. It's basically saying how there's actually a lot more blocks than being produced within a shorter period of time that we've seen in the past. Maybe it has to do with less of a difficulty or whatnot, but basically the miners are racing to collect the rewards that they can right now before the halving happens, and that is going to be cut in half. So it's just them taking a stab at the opportunity to bring in as much as possible, because nobody really knows how BTC will react after the halving event. So there's the risk associated with that. So
yeah, definitely makes a lot of sense there. I think once we saw the drop to about 3,900, most miners probably figured that it was going to be rough moving into the halving. So as we've bounced back up here a little bit, I think I saw something like there was a block being pushed out something like every 6 minutes instead of 10 or 10 plus. And yeah, that ETH article is interesting. This is also, just to be clear, ETH, it's not locked in smart contracts, so doesn't include DeFi, doesn't include any centralized exchanges that are using smart contracts for there. ETH is doing well against Bitcoin, it seems, and just in general as we move closer to ETH 2.0. I've got 4 pieces of news here. First one is on Cardano. So any Cardano fans out there, you're getting a little bit of good news. Cardano has released basically the new version of their Daedalus node and wallet, which is basically going to allow those who are looking to run a full node to get it up and running in a much quicker amount of time. With that being said, Cardano is still kind of I wouldn't say a no-name project, but one fallen by the wayside, especially with Tezos and Chainlink and some of these others growing in popularity in 19 and 20. Cardano is looking to move towards staking, which they still evidently haven't gotten there, and have obviously lost some, given up some headway when it comes to adoption against Tezos and some of these others, like I said. And then when it comes to smart contracts, that is going to happen in basically what's their Gogoin stage, if I'm pronouncing that right, which is being developed in parallel with the current stage of development they're working on. But there's really no ETA on when that will be available. So every day that goes by, Cardano seems to kind of fall behind, even with this new version of the node coming out. So
Charles is still spending that money though, man. I guess not anymore. There's no conferences to go to. What the hell is Hoskinson spending his money on?
Yeah, I don't know, man. It maybe development, but they seem to continue to move slow. So anyway, another kind of interesting piece here. This is from Square. So for those of you that don't know, Square came out with a really kind of Bitcoin focused initiative. It was nonprofit. They wanted to really focus on Bitcoin Lightning Network and doing things in an open source manner for Bitcoin. The first one here that's making news is really that a Square dev has found an exploit in the Bitcoin Lightning Network. So essentially the way that it works is that as these hash time locked contracts are used, they're basically smart contracts that require those that are receiving payments to confirm the transaction by generating this sort of cryptographic evidence. And as that happens, if the payment isn't confirmed, the person that sends that payment is able to claim a refund. right? So if I send Q some payment via the Lightning Network and he doesn't check it or doesn't claim it or whatever, I can claim the refund. Well, this exploit essentially enables the recipient to deny the sender from receiving the refund, right? So you run into this kind of, almost like orphan block setup, if you will. It's where funds are just kind of stuck in the abyss a little bit. It's obviously hard to kind of understand where the exploit might exist, that somebody could take advantage of it and pull cash out, but it is still obviously an attack vector nonetheless. So props to this dev. I think he was formerly a Blockstream co-founder. So pretty impressive that he was co-founder there and then left to work on Square. So interesting there as the Lightning Network continues to kind of chug along. Final two pieces are on the infamous Keep network and the much more infamous Telegram and Tezos class action lawsuits that are happening. Keep is a brand new network. It's got a big backing. Comes from the company Thesis, which is the parent company behind the Keep network. And basically, they are getting ready to launch. So anybody who was able to get in early, like your VCs and your various funds that help support Keep from an early stage, are now able to claim their tokens and start staking as the new mainnet is set to come out here. Basically, the way that it works is the Keep network acts as a privacy option for ETH applications. So it's kind of almost like a side chain in a lot of ways, or at least a privacy focused side chain that allows those who are interacting on ETH to do so in a very private way. This is what the Incognito project is working on, like we were talking about at the beginning of the episode. And there generally seems to be a big push towards privacy on ETH and on DeFi that exists on ETH. So that is launching. It's really going to be a big focus around their TBTC project, which is a way to bring Bitcoin collateral to ETH. And an important piece here for those who want to get involved, there is something happening in June on Keep, which they're calling a stake drop, where you can bond your ETH to the Keep network and earn Keep tokens as a reward. And that is basically going to help secure the system and help get it off the ground as it tries to grow pretty quickly. But they seem to be doing well. They're getting a ton of press. They're going to have somewhere between 80 and 100 folks who are running the Keep network, if you will, from the start. So props to Keep and all that they have done to date here. And then finally here,
was there a max staked supply that you can actually stake to the actual Keep network?
I'm not sure. I didn't look at it deep enough there. Keep is one that I've been meaning to kind of dive deeper on here a bit more. But yeah, I'm not sure as whether it's the bonding of the ETH or if you are an early stage investor and have those Keep tokens. But definitely worth a look.
Yeah, for sure, guys. Edgeware actually ran this like pseudo lock drop that I think sometime last year. Whenever you're doing something like this, like and you guys can attest to this, like you just always have to kind of look at what you would be getting from like a lending rate perspective. If you're looking to like stake ETH for a certain amount of time, obviously you can get a certain amount of percentage back, 4% at this point from like a BlockFi. Obviously there's DeFi services that you can get that return from if you're staking or lending out ETH. So that's something to always consider when you are staking to these projects. It could literally not return you anything. Certainly you're not losing any ETH, but it could lead to maybe potential losses from like a unrealized loss, from having lent out ETH during that time. There's no time period or anything associated, Mike.
Like, yeah, I'm not sure.
Okay, cool.
Yeah, but definitely one to take a look at there. So, and then like I said here, finally on the legal front, because that seems to be a growing thematic within crypto, is all these various class action lawsuits. Telegram has officially waved the white towel. It really looks like they have lost to the SEC. Masari basically saying the SEC clearly won, and this decision could eventually impact other pre-launch networks that raised via a SAFT, standard agreement for future tokens. So what Telegram has said is that they are now delaying the TON launch, their network launch, until April 2021, and have decided that they are going to allow investors to legally reclaim as much as 72% of the initial purchase. This would total about $1.2 billion worth of funds. So that gives you any indication of what Telegram has spent or what they're willing to give up, somewhere around, that 3/4 mark. Interestingly enough, they're also offering investors an alternative option where investors can lend these Gram tokens to, basically to the Telegram project in exchange for 110% on their original investment, or 10% yield, which is pretty significant. That would be paid back in the Gram tokens or another crypto asset. They even went so far as to say that as a part of that lending setup, it might even be shares in Telegram, which I wasn't aware is 100% owned by their founder, Pavel Durov. So, he's pretty much at the helm with 100% ownership of Telegram. You've got something like 400 million monthly active users, which is just insane. And hopefully this is kind of a beginning of the end when it comes to Telegram's legal problems.
Yeah, that's crazy. That 72% that they're returning, it's basically minus all the fees they spent on legal, and and maybe some other stuff as well. But interesting story. Back in the day, the founder of Telegram actually, I think he caught some interest from Russian politics, like Vladimir Putin, where he was trying to get the private keys, so he can read the encrypted messages. And I think the founder didn't give it to him. So I think he was like, nope, that's not happening. So I respect him for that.
And he's still living in Russia?
I doubt it. I doubt it.
You don't say no to Putin, okay?
Yeah, exactly.
Right. Yeah, he's got to be a pretty powerful guy at this point to own 100% of Telegram. I would think he's a billionaire in his own right. But I'm a big fan of Telegram. I like that they're one of the remaining social media platforms that you can use end-to-end encryption on and these various things. So hopefully, like I said, this is the beginning to the end for some of their legal issues with the SEC. Finally, here as we move into more of a discussion, Tezos is another one. Basically, a judge has given initial approval for a $25 million class action settlement to be resolved. Tezos obviously doesn't want to go to court. There's a ton of legal fees that exist. When you do that, it drags on forever. In the same way EOS did, $25 million seems to be that number. The problem, of course, for Tezos could be that as you settle some lawsuits, new ones pop up, as we've seen with some other class action lawsuits in the space. So it continues to be a struggle for crypto projects who have gone out and kind of done this quasi-regulated SAFT or ICO, and now are dealing with some of the repercussions of that. But Tezos, as of late, other than the fact that I think they've got like 97% of total Tezos in circulating supply staked, which is just amazing for a project that size. They have had this drama with legal, and then they had the drama with the founders threatening to basically move on. So it's a interesting spot for Tezos.
Yeah, definitely, guys. We're moving into discussion now. So we're talking a little bit Genesis loan book. We're talking a little bit about the personal token sales. Then we'll get into Bitcoin, Ethereum, EOS, and then finally Ripple. I do want to shout out guys in the chat. Andre's in the chat talking a little bit. He says that actually the founder of Telegram lives in Dubai. So I think we're in the Telegram group talking about we're in the chat talking about RIP Telegram again. Guys, as we move into discussion, and I've moved it on the counter there, if you guys want us to discuss something, and this is kind of like more, I wouldn't call it a debate, but it's more like open flow discussion. So if you guys want to drop maybe comments in the chat for us to talk about, like any type of news in crypto, this is the time to do so. We do love to discuss together, but obviously want to hear your thoughts too on different happenings going within crypto. So without further ado, let's hop into this discussion portion.
Yeah, absolutely. So yeah, just to comment on Andres, that he lives in Dubai. It's like the international kind of middle ground, for like certain people that might be hunted, by certain governments. So anyway, moving right along. So Genesis Capital loan book continues to grow during the most volatile quarter. So Genesis Capital is one of the largest institutional crypto lending businesses. And this basically report describes how their business was impacted by, the Black Thursday that happened, and kind of the details there overall in terms of the lending platforms in general, what their use case was prior to the Black Thursday, where basically what we had is what's called a contango in the market, where the futures prices were higher, trading at the premium, and then you have the spot prices trading lower. So traders, what they would do is they'll buy the spot and short the futures. So what they could do is they basically go to these lending platforms and they would lend. They would borrow BTC or borrow cash to buy more BTC at spot, and then they would sell it on the futures. They would short on the futures, and there's this arbitrage that they could do. Well, what happened was, because of the volatility with BTC, since the BTC price was dropping, that's when the margin calls start getting in for these lending platforms. So, and then when margin calls occur, you basically have a window where you have to deposit more collateral, and you have to sell and wind your positions, which essentially escalated the whole Black Thursday volatility in the end. So there was a huge, liquidity problem. And the way the market was structured in the past with the arbitrage that existed, that definitely kind of propped up like the loans and lending space for players like Genesis Capital. But overall, I mean, as things stabilize, it looks like the lending platforms are stabilizing as well. So the question, that we have obviously, and that everybody's trying to explore is that, are the lending platforms really reliable? Are they good for crypto? Are they good for BTC? Since we had this issue that occurred in Black Thursday that also was fueled a bit by the people that were borrowing, the need to scramble for collateral, and what's the how reliable that is. So Mike, I want to pitch it to you. What do you think of this? The risks that are associated with lending at present in crypto.
Sure. Yeah. I mean, obviously congrats to Genesis for reaching this all-time high. I know they were one of many, like you said, that saw a huge drop off in their overall lending book whenever March 12th happened, but they've bounced back, and they're pretty legit in the space. They do a great job on the institutional side, but I think from a risk standpoint, there is not a ton of risk in working with a lot of these lending platforms. Obviously, nothing we say here is financial advice, right? But when you look at folks like a Genesis on the institutional side, or a BlockFi, Celsius type, who kind of sit in the middle there between your institutional and your more retail user base, they're going about this new lending and borrowing schematic that now exists in crypto, alongside, or with risk management techniques that they're bringing from the traditional space. I think more of the risk exists when this evolves into kind of more funky derivatives, where then it's a bit harder to kind of quantify risk during black swan events. But if it's really just primarily lending and borrowing that happens with your large institutional clients who are trying to take advantage of some of the alpha within the crypto space, or lending and borrowing that's happening with BTC miners, there's not a ton, right? I mean, for those of you who are lending and borrowing with a Celsius or a BlockFi, I think the biggest risk is that because you're not going to be putting up as much funds as some of these larger institutions, right? Unless you're lending or borrowing millions, you're not going to be given as much importance on the book relative to these larger firms. So the chances of you getting auto liquidated are much higher than somebody who obviously is a giant client for BlockFi or a Genesis or whatnot. So, I think we see more of that risk on the derivative front. And my one of my thoughts when reading this article was, if you look at March 12th and understand what happened, right? What does kind of this multitude of lending and borrowing do when the market sees liquidity dry up, right? Does it spike volatility? Does it help volatility? Kind of where does the market fall with all of this new interest coming into the space? And as we saw on March 12th, obviously it increased volatility because we saw such a move downward, and that sell pressure increased pretty dramatically without a similar increase in buy pressure. So, short term, I think there's more risk in some of these lending programs just creating overall volatility for the space.
Yeah, no, that's I agree with you on that point, especially during the time when the market makers are pulling out and liquidity kind of dries up and you have these gaps in prices,
right,
for sure. But in general, just thinking from the traditional finance side, obviously these products are good for what I've mentioned in the past, which is called the price discovery, for BTC. But obviously that comes in with some volatility during these times when it's a kind of like a black swan event. I like the what you mentioned about the maybe structured product, or like a derivative that would be basically structured around the arbitrage that's done between borrowing, lending, and futures and spot and so on. Yeah, those trackings can be definitely impacted negatively if we have a black swan event again.
I'm really wondering what your guys' thoughts on the timeline of institutions being comfortable now with Ethereum, right? Like, as you see composability, as you see market cap increase, things that could be said right now about Ethereum and institutions could have been said maybe 5-6 years ago, maybe even as little as 3 years ago about Bitcoin. So is there a timeline where institutions feel comfortable settling on the Ethereum network? Anybody?
Yeah, it's a good question. From a settlement standpoint,
I think we're lagging a little bit. I think we're having some lag issues.
Yeah,
just a little bit.
Yeah, so go ahead. Sorry about that.
Go for it, Dean.
Oh, me? Oh, okay, my bad. Well, what I was gonna say. Oh, yeah. So I think the main interest from the institutional standpoint in regards to ETH is really the stable coins. I think that's really where the interest is coming through, because, hey, if you're an institutional guy and you're looking that you're going to be sitting in cash for some time, I'm not going to be sitting in cash and buying like T-bills or something, get out of here with this trash interest.
Mm-hmm.
So what you do is you just, hop into some of these stable coins, diversify into different baskets. We've seen USDC, going higher in terms of market cap. Paxos has been doing well, so all of those things, that they can allocate and get the pretty nice percentage when it comes to holding those stable coins from lending on a lending platform. So I think that's really kind of what, from my perspective, I think that's what is, kind of bringing together institutional players into ETH. I wouldn't say like it's, because of like maybe some like smart contract that's or an app or whatever, so I think it's more around just the stable coins.
Yeah, for sure. I mean, from a settlement standpoint, my question has always been, why use a public network that is slow and often congested versus just some private version that's a white glove service and a lot simpler to use, probably from a front end standpoint. So I think it's probably, it's less on the settlements front. I think the stable coins, like Deem said, are interesting, especially because it's kind of this new avenue for lending or borrowing for a lot of bigger players in the traditional space, or at least more creative players. Like we see Jump and a handful of others moving into the DeFi space and trying to kind of understand what's happening there, where they can pull out returns there. I think that as ETH moves to ETH 2.0, that will be a real catalyst for institutions to take a broader look at staking and some of the opportunities around staking. There's anytime you can, pull out significant interest rates like a 7 or 8% in Tezos, or even higher on some of these, some of these other lesser known staking platforms, you start to get the attention of bigger projects. And I think ETH is really poised, assuming they can execute on ETH 2.0, to put staking in the minds of some of these more institutional players, as you see. So, you hear a lot about like, oh, some accounting firm is testing ETH, or the Sacramento Kings are using it, or whatever. And I think more of that is just kind of around marketing hype than anything else, and in a way for that organization to say, hey, look at us, we're innovative, versus the actual kind of financial use case or alternative in a lot of ways that staking might be, if ETH can pull this off.
Yeah, and then I want to just add to that, like what you were saying in terms of the staking rewards. For example, like Tezos, it would be hard for institutional guys to get into that, because you get in rewards in Tezos, and that's volatile, and it's kind of attached to the BTC. So, unfortunately, a lot of these, projects and their price of the token is attached to how BTC is doing. So. And in regards to stable coins, obviously that's just 1-for-1 all the time. So it's kind of easier to get in and reap the rewards there. But, for others, it's kind of tricky there, because there's that volatility that they're exposing themselves to,
That sounds like a perfect opportunity to have an intermediary come in and do that for them.
Exactly.
Right?
They're going to package that, right? I mean, we already see Tezos and ETH, ETPs, or these exchange traded products that exist in Europe and a variety of different places. So if I know I can get 7.5 or 8% on Tezos, well, I'll just give you 5 and take the difference, right? Mm-hmm. And give myself, 50 basis points of buffer or something like that, and kind of move forward that way. So it's going to have to be a regulated way that a lot of these larger institutions come in and yield chase in a lot of the same ways that retail folks do. They're not going to be doing it directly on chain with some open source ETH wallet or anything. But they're not going to be participating in DeFi by any means. But, I think we're moving into a period where it's going to be really hard to get a positive risk-free rate. So people start to look more towards high yield and look more towards other alternatives that haven't been explored yet. And if they can pull out some relatively risk-free alpha there, they might take a jump.
Gotcha. All right, guys. Well, we're about. Did you have anything, Dima, there?
No, I mean, just to kind of wrap it up. Like, the last thing that I want to mention is just in terms of rates in general. I think if there's a demand for for these rates in terms of lending, we have to have a matching borrowing demand for that to keep the rates at the same time. Where they are now. So if we're going to see an influx of institutional guys getting in and start lending out at very big, supply, then, perhaps we might see rates go down for the borrowers.
Gotcha. All right. So we're about 45 minutes in, guys. Appreciate everybody. I think we got up to about 16, 17 at one point. We got about 14 in the chat now. So appreciate everybody kind of following along if you're listening afterwards. One more thing. If you are following along, you can actually refresh that browser now, and every story that we're talking about is now in the description. So we'll have that for you guys, that way you guys can follow along, kind of story by story here. We did have a couple interesting questions here that the community wanted to get to. Scott was asking, what do you guys think about PBTC on EOS and Ethereum? PBTC is basically like that wrapped BTC that we're going to get to here in a second, but we will talk about that once we get to Ethereum, Scott. Another thing, 1-2, the thing about crypto, everybody wants to be a trader instead of a long-term investor. We'll interact with the project. Traders don't care about the project. It's all about the gain, so I can't hate. So there's kind of some comments there. Do you guys want to take a stab at traders within crypto?
Yeah, I wanted to reply to that. So, one thing that you have to realize, actually, the traders and speculators, they provide a very significant part in our ecosystem, and that is liquidity, meaning that you can get in and out of your token project, whatnot, or let's say the foundation needs to cash out some, whatnot, right? Traders provide, those that day trade this, they provide liquidity and the ability for people to get in and out. So there's obviously a balance there, for speculators and long-term holders. You don't want to have too many speculators, or you don't want to have maybe everybody just hodling it, because then there will be no liquidity and get in and out of that token. So it's a healthy balance between the two that really makes this whole kind of thing work. Just keeping that in mind, not hating on one group or the other. We're a whole big family working together,
You got anything there, Mike, before we go to the next topic?
That's fair. I think the elephant in the room when you're talking about traders versus investors is the lack of utility other than speculation, right? Like, what projects out there show some utility. You could even, I include Bitcoin in this, right? Lesser than most projects, but Bitcoin as well, right? Like, what utility exists as a majority above speculation, right? The majority of crypto, any utility around crypto is still speculation. I think from ETH, right, you have some interesting things happening on the DeFi space, and they've obviously dominated smart contracts. BTC, right, it seems that the largest utility it has as of late is just as a way to get into better fiat, which is ironic in a lot of ways, right? If I'm in Iran, like we were talking about, or Venezuela, and I have $100,000, and now that's my purchasing power is being removed by the minute, right? I want to move into something that is stable and is a store of value, which Bitcoin really has not in any time less than 12 years. Done a good job of showing as a store of value, in my opinion. So I think you have to remember that, right? Like, what's the benefit to being somebody who's able to get in and get out and make profit in fiat versus somebody who is able to hold some token for the longer term that is struggling to find utility outside of speculation.
I honestly would kind of push back there. I think like when that Black Thursday, am I coming through? I don't know if we're still having lag issues, guys.
Yeah.
Okay. I would kind of push back there and say, like, when Black Thursday actually happened and we saw the S&P and the Dow kind of like fall, as well as Bitcoin, obviously in that like ridiculous spiral. But I feel like its performance over the past, it's a small time period, but you can see it kind of decoupling from the actual traditional stock market. In a way, its performance has outpaced the traditional stock market if you're looking at certain time frames. I know that's kind of like looking at what I want to look at. But I would kind of push back and say, like, it does have utility if it does decouple itself from the traditional market and it becomes its own kind of store value asset.
I was going to add to that, I think Bitcoin kind of falls more into the commodities crowd rather than the stock market guys, because with the stock markets, it's kind of, you can calculate like, all right, due to this economic slowdown, here's the financial sheets, and you can do the math of, all right, if the company like airlines are not going to be operating for X amount of time, they're going to lose X amount of money, blah, blah, all those things. You can do a math equation, then like, okay, cool. Now, this is way overvalued at these prices. Now let's dump it. Right. But like for Bitcoin, and you can't really do that. Right. So that's why it kind of falls into the commodities side, where it's like, well, okay, it's fueled by the demand, and obviously the fixed supply that we have of Bitcoin. Gold, I guess, could be like something that's similar to it, but the correlations, it's tough to talk about the correlations with the stock market, but we've seen that, right, in terms of risk-off environment, where we have the stocks kind of falling down, we have some Bitcoin falling down, or the chase for liquidity, to maybe sell out of certain things like Bitcoin to prop up the margins and other products that they hold in a portfolio and so on. So that's kind of my take on it.
Yeah, I thought that was a great point that you guys were making that week that it actually happened, where people were just looking for like any liquidity that they had, just get into fiat. I thought that was an absolutely great point. And that store of value narrative kind of got thrown in the laundry essentially, but I really think that over the past 3 weeks, I've been very surprised. I mean, obviously the stock market's performed kind of weirdly well as well, and I'm not trying to say that Bitcoin's not a commodity. I think that you're correct. It's just, to my mind, being able to have that commodity and actually have something that's kind of not correlated with the actual market, which we've seen, is more of a utility than maybe Mike was giving it credit for. That was just the kind of comment I was.
Yeah, not correlated asset. Yeah.
Yes. Yeah.
Right.
Yeah. Mm-hmm.
So
yeah, no, it's definitely more of a kind of negative or cynical outlook there, around the kind of the speculation as a major use case. Right? So.
Yeah, Scott's in the chat also saying that utility of being non-confiscatable. I couldn't find a better word to spell better. Not your keys, not your crypto. So we've got some comments coming through. A good discussion, man. We definitely like to have these discussions rather than just kind of speaking to you guys. We want to speak with you. But all right, without further ado, we'll get into this next story, which is a very interesting topic and kind of grouping sector process. I don't know exactly even how to place it. I guess fundraising method that has come about over the past, I would say, month. Obviously, we had Alex Masmej on the Layer1 podcast to talk about how he started via this company called, I believe, Roll, where they are basically issuing personal tokens. So Alex was able to have this personal token issuance and then have a pseudo ICO based on himself, and raised about $20K from various investors from some of his following on Twitter and things like that. That got some blowback. I know somebody within the Ethereum community, some popular Twitter profile kind of called out Alex, saying that it was a little bit, I guess, aggressive in that it was very like... just anything that you could say about an ICO when they were raising, maybe ICOs that didn't have a lot of their roadmap planned out, just a lot of things. In basically, Alex was able to respond. I kind of responded there with him, saying that I think these personal token sales actually are good for the community. I think they're interesting to experiment with, but I also think it's kind of a Pandora's box, of which this story is part of it, where you'll see not only guys who are really well-meaning with their like token issuances and what they're going to do with the money and all of these things and start companies. What you'll start seeing is just a proliferation of personal token sales for people that have no want to even pay back their investors or anything else. But basically, in the tweet is actually in the description, guys. This is a initial, I guess, what are we even calling these at this point? This is an initial token offering for a guy named Kerman Coley. The token is Kerman. He's going to basically raise 1.5 million tokens, a total of 30,000 USD. So there's a lot to unpack here, but basically people are issuing these personal tokens as a way for them to raise money to start different businesses, to travel, to conferences, to travel. I think in Alex's case, to actually move to San Francisco to actually gain that networking community. So I guess I'm going to explain some of this and then ask you guys the question of, is this viable? Is it, what do you guys think about initial, this, I guess it's initial Kerman offering. We gotta really think about a better word here. But these essentially human ICOs, I really want to get your guys' opinion on people raising money from investors on the promise of maybe future earnings that they would pay back to those investors. So I guess like through this link, you can go and see the actual token details. Again, it's going to be about 30K he's raising from specific investors, 5 cap. There's a $5,000 cap on how much you can invest. Vests over 3 years. He's going to have these... He's going to issue these tokens and basically burn them through, I I guess he's going to burn certain tokens. This is very interesting. I need you guys to save me here, but basically he's using these tokens to, invest in himself, and he's going to do a certain type of utility, which is going to allow him to burn the tokens when he's actually making money. So from the money that he's making, 5% of all of the revenue that he earns is going to be to go back and burn these tokens. He's going to have utility of people being able to use these tokens to determine what he does on a day-to-day basis, as well as like access to consulting from him, access to different portfolios of coins that he's investing in. So super interesting stuff. It's like so bleeding edge that I don't even know how to kind of transcribe it to you guys and really discuss it. But I just wanted to get what your guys' initial thoughts on like these personal token offerings and where you see it going.
Deem, you want to start?
Oh, great.
You want me to start?
I get to go. No, you go. You go.
Yeah, I don't know, right? Like having seen the good things and the bad things from ICOs, to me this stands to harm more than I think benefit. Some other interesting points here on Kerman Coley though is so he's 22. He's basically the one heading up all of kind of the goings on, if you will, at Immutable, who sold almost $7 million worth of NFTs for Gods Unchained and raised a $15 million Series A, right? So it's not just like some random person who has nothing to do with crypto taking 30 grand from people. The post is interesting. He talks, obviously about how crypto is going to be the biggest revolution and all this. And one of the things that jumped out to me was in this initial Kerman token offering for $30,000, that is 15% of the total supply.
Yeah.
So who gets the other 85% of the tokens, right? Does that go to, your early stage VCs or whatnot? And, my final question on this front is, how does this ever pass through the regulatory constraints with any sort of utility, where when you judge this at a Howey test, it looks like anything other than just an unregulated way to raise money via peer-to-peer loans?
Yeah.
So,
I kind of, I see what you mean. I like the comment that 1-2 mentioned here. It sounds like a Kickstarter. I feel like it's more of just, kind of a fundraising tool. And I think if people focus really on the return on the investment, then yes, a lot of people are going to be hurt. But I think if you look at it in a way where you're fundraising and helping somebody out, and if they do well, then maybe, there's going to be some kickback there, right? But really what you're doing, you're really just helping them out by raising these funds to, do the things that they love to do in crypto community and build things and so on, right? So the interesting thing about this is what you mentioned, actually, the 15% total supply, right? So there's obviously the other part of it, which, once this actually goes through the initial Kerman offering, the IKO.
Let's settle on. I think the term is personal token offering. I think we can settle with the PTO. That makes a little bit more sense. But go ahead.
Yeah. So once it's released and everything, it's going to hit the exchanges, and that's when the speculation is going to take place on these, and it's going to be interesting because really you can do the math and calculate where it should be trading, kind of like between what range, because it's kind of like prediction markets at that point, because what is the prediction of that person actually like making him paying back or burning these tokens. So it could be trading like anywhere between 0 and 1. So, and that's going to be interesting to see how, one being that, he's going to be, repaying the initial investments, and 0 being that he's not. And that's where I think the price is going to be fluctuating for these tokens once they're released. The thing is, though, it's interesting is that, once it's on the exchange and it's going to be trading on these prediction markets, the rest of that supply that somebody's holding, I wonder what they're going to do, with that supply once the actual exchange of that token is priced in the market, right? So that's
I think the burn mechanic is specifically different than anything that Alex was doing with his token, and I could foresee Alex actually retroactively going back. I don't know how the governance works with the Alex token and how that all works out, but I could see them retroactively going back and adding a burn mechanic because it is interesting, right? So like he's got it laid out here. People can use Kerman tokens, which I'm sure if they're not investing at the early stage can buy, like Dimitri's saying, on some type of exchange. I think even Alex had that airdrop, and he said that actually sold out or was used up. That link that we put on the Alex episode, you guys went in there and claimed that 500. I think it was up to like 1,000 Alex airdrop, which is nothing, but you guys still like got in there and got some Alex tokens. But basically, you can use these Kerman tokens for hours of consulting, a year of DeFi weekly subscription, which is his like little newsletter, retweet of comments, and he's using all of these as well as the revenue, the 5% of his revenue, to go back and burn the actual tokens. So any revenue that he's using, he's buying that up off the market, burning it, as well as anybody that's paying him for his services, he's using those tokens and burning them completely. So I think the burn aspect is interesting. This is all kind of semantics, right? But I do think I like Scott said, he said that would be a good method for first-time real estate agents to fund themselves before they earn a commission and then pay back the investors with some interest. It's interesting to point out too, like that's something that Alex talked about when he was on the episode, right? Like he was basing this initial token offering on other things that people have done in the past, which is I forgot what the actual term was, but essentially people would there's processes like this right now for education. Someone can go to a trade school for free and then pay that trade school back with like 10% of their revenue over a certain amount of time. So the things like this exist, but it's interesting to see it be tokenized. I do agree with the regulation. I don't think one of the questions I posed to the Twitter community actually was how long it takes for this stuff to go viral, right? Like I didn't expect for another token issuance to happen within like the next week, but these might happen quicker than I think. But and then two, how long does it take before people start realizing, like government officials start realizing that this stuff is happening, just like ICOs? I feel like, Mike, you were there early days ICOs. No one's giving a shit. People are making tons of money, and eventually people start figuring this out. They're like, what the hell's an ICO? We need to regulate this, yada, yada, yada.
Yeah. And it's not to say that everybody who would do this personal token offering would obviously be in it kind of for the wrong reasons. I think it's just, it's maybe just like a lack of structure, right? You saw that with some of the early stage ICOs, some of the later ones, where if you're in this gray area from a regulatory standpoint and you go and you raise all this money, it becomes sketchy. So you're removing the idea for a business, you're removing the idea of a team and narrowing it down to one single individual. Maybe we see some structure, emerge where you have, say, a single platform that is regulated like a Kickstarter, who is able to kind of take that burden and thus take their fees and allow for some of these personal token offerings to continue to boom. But I mean, to your question, right? As is the case with crypto, if this is raising a bunch of money or if it's getting a lot of interest, I think we're going to see an exponential amount of people come out of the woodwork and say, hey, here's my goal, for myself, right? Give me money for this reason. But the regulatory piece of it is a nightmare. The final piece I'll say on this is I think this is potentially a larger trend around yield, and the concept of kind of a quote unquote risk-free yield that people are going to try to get in crypto. It started with lending and borrowing, and it's done by these trusted institutions. And as you do two things, as you raise the amount of yield, and lower the legitimacy of the issuer, you run into sketchier territory. And I think as ETH 2.0 comes about and as more staking and as other kind of DeFi or non-DeFi yield focused products, whether they're personal token offerings or not, as more of this happens and that rate goes from 8% on stable coins to now 18% on a personal token offering, and then the next guy's got 21% on a personal token offering, and it gets to a point where you have these crazy yields and people are throwing money at a 60% yield that is never going to be able to pay itself off. Then you run into this giant kind of credit bubble, if you will, within crypto, where a bunch of people who don't really understand how it works, or a bunch of brand new buyers come in, or yield chasers come in, and you see kind of the crash like we saw with ICOs. So I think that's kind of a bigger, broader danger. It's just this general yield chasing when those yields are unrealistic.
Yeah, and if you pair that up in addition to these guys that are raising funds are not hedging the ETH, whatever they collect, right? Going back to ICOs, where if the market tanks, then the 30K that they collected now is devalued by a lot. So yeah, it'd be interesting to see how that goes.
Yeah, a couple points here. Roll is actually the company, and I can actually link it here. It's tryroll.com. This is the actual company that's doing the infrastructure and doing all of the issuances for the token. They actually took an investment in Kerwin to start out with. So they're actually part of this initial raise. I wonder if they'll do that, and I hope to actually get them on the podcast. I always love to hear from the actual horse's mouth what's actually going on. I think the idea is sound, right? Like it's like the comments in the comment section are there. It's like Kickstarter for people, right? Like that makes sense. Like people should be able to fund. One of the stories I remember hearing, like a Garth Brooks documentary, and basically all the people in the town pooled funds so that he could go off to Nashville and really like chase his dream. That's essentially what this is, right? Like a big amount of people are funding one individual, and we'll see if it ever pays off. Now, I don't know what Garth did for the community there and all that stuff, but the idea seems to be sound. I think Spencer Dinwiddie was doing this with his contract with the NBA, and I think we were a little more bullish on it because he was going about it in a more regulatory like process under that framework. But we still like the idea. I'm super bullish on this, man. I think Ethereum is continuously showing that they can innovate. I think there is an issue if we look at things and say, okay, someone somewhere is going to bastardize this process, just like the ICO. So we shouldn't do this at all. So I'm bullish on these token issuances. I think there is going to be somebody that raises an outsized amount, like $1 million, and some people are going to get pissed off. I mean, to be honest, this is $30,000 with a $5,000 cap, which is a good amount of money to some people. But it's not raising $1 million, $2 million, these not 20 yet. Million, $4 billion.
That's how ICO started.
Yeah, exactly. So, hey, I love that comment. That is kind of why I brought it up to you guys. This is how ICO started. It will be interesting to see where this goes from here. So, appreciate your guys' thoughts on that, man.
PTO alert.
Yeah, win PTO alert.
Yeah. So if we're wrapped up with that,
let's head into Bitcoin.
Yeah. Let's go to Bitcoin. So I know everybody knows this because everybody watches Dimitri's Desk. But so basically, key data came out saying that the surge in BTC price has been actually fueled by the spot exchanges. And as a matter of fact, US is one of the top ones that is, seeing huge demand coming in into exchanges like Coinbase. And we've seen, when BTC popped, the Coinbase actually went down because everybody's trying to FOMO, I guess. Unlike what we've seen in the past, where derivatives exchanges like BitMEX, they had, basically the ability to kind of, push the price higher because you have leverage there and there's more open interest because of that leverage. And that product essentially started pushing the spot price. So that's not the case. Looks like the spot price, the spot exchanges are coming in with heavy volume, while the derivatives exchanges like BitMEX, they're actually dropping off in open interest. and dropping off in overall volume. And that kind of goes in hand with the overall market, what we've experienced on Black Thursday with, all that systematic issue that happened and volatility picked up, and a lot of leverage positions got liquidated. I mean, you don't even have to be leveraged a lot. You could have been leveraged, even 5 to 1 or 3 to 1, you still got destroyed by the move. So I think overall, the general market is taking a step back from leveraged products at the moment, because they've seen what volatility, they forgot what volatility we can experience in crypto. And that was a huge wake-up call for those that trade leverage products to take a step back and perhaps get into spot, because it's safer, it's not leveraged, you're not going to be liquidated, you can sit on it for a while. And overall, just given how the global things are moving, nonstop printing press, I'm pretty sure a lot of people are starting to get interested in BTC as far as the spot price goes for the longer term rather than the short term returns while using leverage products, from derivatives exchanges. So yeah, what do you think about this, Mike?
Yeah, it's definitely, we've seen this as a spot move. I think stable coins are something as well to pay attention to. But if you look at the last 5 days, right, Wednesday and Thursday were giant spot moves. Just looking at Coinbase, almost 3x normal average volume over a 3-month period. And then looking at this past Sunday, yesterday, the total spot volume on Coinbase was about $7 or $8 million larger than that 3-month average as well, when typically you see weekends being much slower relative to weekdays when it comes to that spot volume. So I think, like you said, from Black Thursday, this is a move that a lot of people didn't expect. Obviously, we had BitMEX kind of shut off at around 3,900, and we popped back up to the 5K range, but to jump from there all the way up to almost 10K, certainly we're over 100% up from the 3,900 level, is one that a lot of folks didn't expect. But when you have such a flushing out of open interest on the future side, and then you have things like stimulus checks and money printer go brrr, memes happening, it's not too much of a stretch to see retail kind of jumping in, right? The question is, of course, can this sustain over time as the halving hits here in about a week, about 7-8 days time? Or are we going to see things start to normalize? Funding rates normalizing a little bit. Futures markets are normalizing a little bit. We got Bitcoin open interest climbing here over the last few days or week or so. So, beware, right? It's still a tricky time, I think, for crypto and obviously for global markets. But at the end of the day, time will tell as to whether or not a lot of this spot volume demand can keep up and push us higher, maybe over a 10K or so.
Yeah, Kieran's in the chat saying burr. Mike, that was possibly the best money printer go burr that I've ever heard. And I've heard a lot of them, man.
I've been practicing in the mirror.
Yeah, I was going to also mention that, after the halving event, we'll see how the price is going to obviously be impacted for BTC, and we'll see what is the risk tolerance from these retail guys that are getting in and hopping into spot. If we're going to start having a BTC, move lower, even if it's not leverage position, the retail guys might not have as much risk tolerance. They might be starting to dip out. And in general, we know the cycles where, like, okay, the institutional guys are getting in. We have all these other things that are happening, and then the retail kind of gets in at the end. So it's kind of, we have to be cautious with retail getting in so heavy right now, right before this fundamental event. Meanwhile, when you have institutional guys, miners, and so on, they're actually hedging this risk out, right? They're actually rather not they would lock in the prices what they have right now rather than deal with the whatever is going to be after the halving happens, because there's an unknown event which is going to create unknown volatility and so on, right? But retail is looking to bet on that to go higher. So it's tough. It's tough to make a very bullish scenario in the shorter term as this event approaches, especially with the retail happening at the end.
Place your bets, right?
Yep, there you go.
For sure. Well, moving on here, unless you have anything else, Q, we can talk a little bit of ETH news. We got some interesting things from Vitalik here.
Let's move on to ETH.
Yeah. So in some interviews, Vitalik talked about two things in regards to Ethereum 2.0. He talked about the actual issuance of new ETH. Then he also talked about the Ethereum Foundation staking plan for ETH 2.0. So starting with the latter, he did mention on a Crypto POV podcast interview at the end of April that he thinks the Ethereum Foundation should commit to staking about the same percentage of money that the entire Ethereum ecosystem stakes altogether, right? So if the Ethereum community stakes $100 million worth of Ethereum, he thinks the Ethereum Foundation should match that to help with some of the potential of like manipulation around the proof of stake model, where if one big player tries to come in and dominate, they're not going to be able to, because the Ethereum Foundation is always going to hold somewhere around that middle point, or that 50% of staking. Now, obviously, at the same time, the Ethereum Foundation will be earning a ton of tokens there as well. So that's super beneficial for the Ethereum Foundation. Before I get your guys' thoughts on that, the other piece was that he referenced the Ethereum issuance and how it was going to change once ETH 2.0 was launched. So evidently, with the proof of work set up, there's about 4.7 million new ETH that is created every year. And Vitalik thinks that should be dropped down to right around 2 million. So more than a 50% drop on that new issuance rate, which, when you look at selling pressure, right, and understanding that just like you have with the Bitcoin halving, if there's 4.7 million new ETH that's going to a handful of various pools or Ethereum proof of work miners, and that's going to be chopped in more than half. That is quite a bit less selling pressure theoretically that ETH is going to see. So, two interesting points here. Q, what are your thoughts on this?
What did I make like a motion like I needed to talk? Was that my motion, guys? You got my tell. No, I mean, I guess the one thing I would say about that issuance is that the run cost for Ethereum miners are going to like effectively not go to zero, but with the move to proof of stake, they're not going to need to actually have physical hardware. So I'm guessing that they won't need to sell as much Ethereum to keep up and stay above that red line. Correct?
It's an interesting transition that some of these miners are going to try to make and some aren't. We've talked before on Layer1Live about how there's a real risk that ETH is forked and the proof of work chain, it's kind of a non-Ethereum Foundation chain, if you will, or non-Vitalik chain, continues on with those miners who don't think moving to proof of stake is the right move, because they've built such a big business around mining with proof of work, and maybe the difficulty around Bitcoin is just too high for them to jump in. But with proof of stake, right, obviously you need to have ETH on hand, and we've seen a giant boost in open interest for ETH on futures exchanges. We've seen some serious spot volume for many months before this point, even before kind of all the coronavirus stuff started. So
Go ahead.
It's hard to say kind of like what ETH 2.0 looks like. And I think that's where a lot of the risk comes in. It's like, okay, well, if the majority of these proof of work miners don't come over to proof of stake, and you have mostly, somewhere around 32 ETH, the minimum to stake, acting as stakers, what kind of risks does that present to ETH?
Yeah, that's a really good point that you make. I feel like that's an extremely like bullish kind of situation for ETH, because what you're actually having is when you're in a proof of work system, you're buying and spending capital and putting capital into these actual physical hardware, and then getting ETH in return and selling the ETH or doing whatever you want to do with that ETH. But in a proof of stake system, you need to go out and acquire more ETH in order to actually stake to this system. So if you let's say there's new miners that come about in the next 2-3 years that want to get into the business, and I guess it wouldn't even be mining at that point, it's validation. But instead of going out and actually putting their money into physical hardware and then taking like their supply of ETH, they're actually having to reach into the supply of ETH, purchase ETH, and then stake. And then obviously they get the ETH from that. But that's actually like an extremely a bullish situation for me. I hadn't even thought about that to this point.
Yeah, definitely. And on the other side of it too, with the current proof of work miners, I think that explains a lot of the open interests that we see on the futures exchanges with ETH. If these miners are using, as Dima said before, these futures markets to hedge the price and try to hold on to as much ETH as the proof of stake transition happens. While that maybe puts a little more risk on the futures market as open interest increases, you can still even assume that the leverage they're using isn't all that significant. They're probably just shorting 1-to-1. But yeah, I mean, if ETH can pull this off, it's definitely a bullish moment, and I think the institutional schematic is set up well for ETH with some of the things that Tezos has done already. So it's it all comes down to executing at the end of the day.
Yeah, I think in general we should see miners right now, especially on Ethereum, probably hoarding ETH and not disposing of it to pay for the bills and for the upcoming change. So that's where they would come in and use these lending platforms and get stable dollar using ETH as a collateral because they don't want to get rid of ETH. So they use that lending platform feature to just get their cash and pay for the bills and so on. But overall, I think the ETH 2.0 is just it's exciting and it's also kind of scary because it's at the end of the day you can work on this, for a very long time and try to make it as perfect as possible. But we know that whatever's on paper and whatever seems perfect, once it's released to the market, that's really when it's going to be tested. And with that being said, this change is happening while there's many different things that are on ETH right now. You have stable coins, you have DeFi, you have all these things that are, all of them are kind of, have their own sectors and everything, right? And with the change of to ETH 2.0, like that really is going to expose maybe some certain things that might not work once it's released to the market. So it's an unknown risk that can be calculated by a fundamental event that's coming. So I think that might be a little bit scary. And we'll obviously have to see how that's going to go. In regards to the forks, I mean, Ethereum Classic, right? That's they could switch to that, right? That's going to be proof of work for. Yeah,
and ETC has seen a big bump in price. You'll see kind of these huge spikes, and they're definitely in a prime spot to pull over a lot of those miners who don't want to give up their current business model.
Yep.
Yeah, that's a good point. I want to point out that we should have a layer 1 drinking game, and I think the guests, or I guess the community needs to kind of think about what do we want to have, because Dimitri is like a great example. Whenever Dimitri talks about a Kane Warwick quote, that's a drink. Because that was definitely a Kane Warwick quote that you just threw out.
Yep.
And what you're talking about with ETH 2.0 definitely makes sense. It is kind of in a very much larger scale what I was talking about with Voice and EOS. It's why have this future thing and not why, I guess it's just you have this future event or product that is going to affect your processes or your kind of ecosystem either positively or negatively, and you kind of place that there. And certainly the Ethereum Foundation's taken their time with ETH 2.0, so we can't say that they've rushed this by any means, but they have set this thing in motion. And like you're saying, it could be positive, it could be negative.
Yep.
So
for sure.
I've got a quick. I did want to talk about a comment in the chat. Andre from Incognito said he's going to finish watching later. He has to go now. Really good podcast. Subscribe for the next episode. We appreciate your support there, Andre. Thank you. We didn't get to Incognito before he was able to leave, but I'm sure he'll listen afterwards. So I have a quick piece of news. Ethereum 2.0, we were just talking about it. Their multi-client testnet has just launched. I believe it's called Schlessie. Hopefully I'm saying that right. Up to this date, they've named all of these different testnets and different things related to 2.0 based on cities, primarily cities in Europe. So hopefully I'm saying Schlessie correct. This is their multi-client testnet. It's kind of like getting ready for the mainnet that's potentially getting launched. Like we said, Ethereum 2.0. I forgot the actual name of what is the name that they're planning on for Ethereum 2.0.
Oh man,
this is like a quiz.
Yeah, I can't. Yeah, there's so many.
Yeah,
I can't remember the final version.
Yeah, it started with an S. Anyways, this is basically a Serenity. So basically, this is in the run up to Serenity. Nothing much to report. I mean, obviously, this is good news for Ethereum 2.0. But this is just another testnet that's going live. It had a little bit, I guess, more functionality than the previous testnet. So it's good to see Ethereum 2.0, like we just talked about, moving towards, moving to a proof of stake system.
Yeah, moving towards launch there. Yeah, and I think last week, even only a week ago, we were talking about how the multi-client testnet was going to be the next thing, and here it is. So like you said, good to see that happening. Final piece of news here on ETH is some Maker Foundation things happening. They have added WBTC, which is wrapped Bitcoin, which is basically just an ETH token that's a derivative of Bitcoin. Mm-hmm. That's been added as collateral on the Maker DeFi platform, which is just like a TBTC or an IMBTC or PBTC, one of many competitors who are trying to bring Bitcoin users over to an Ethereum based DeFi platform. It looks like Compound is doing some other things there as well with Keep that we didn't talk about, kind of evaluating whether or not they're going to add TBTC as Keep launches their project. But there's a bunch of different competitors in that space, and it looks like of all of the various DeFi platforms, Maker is the one who is kind of most willing to explore adding additional collateral, especially as DAI has had problems as of late. So some news there. And then finally on Maker, they have added some new members to the board of directors. So we talked a few weeks ago about how Rune and the team at Maker had basically talked about some interest in further decentralizing the Maker Foundation and how they really wanted to kind of move on and, like I said, make it more decentralized. The board of directors now will have someone from a company called TrueLayer. And then we'll also have a pretty well-known law professor from the University of New Hampshire who runs the kind of the crypto group up there. So they're making some moves. These seem to be some pretty big players. The person from TrueLayer had some experience at Apple working there, and it's in general a good move as Maker tries to kind of settle and hopefully return things back to normal. They have some legal problems as well in a class action lawsuit that's happening there. So props to Maker, who's moving on here and trying to get to more of that hopefully just business as usual point, if you will.
Yeah, Scott actually had this comment earlier in the episode. It was, what do you guys think about PBTC on EOS and Ethereum? It's hard to find kind of any negatives that go along with interoperability, especially like when it comes to the smaller chains. And I say smaller chains, even though they're freaking huge compared to the really small microcap networks. But so like PBTC, WBTC, whatever have you, adding Bitcoin into your actual network and allowing the composability with that is amazing. I mean, in order for Bitcoin users previously, they would have had to, before this wrapped token, they would have had to go into that Ethereum and buy Ether and then be in a whole nother network that's completely sectored off from just having composability with their Bitcoin, right? And doing these things. It just adds more friction. So I'm kind of like throwing this to you guys, but I don't really see negatives around adding different composability to your network, which is essentially what adding WBTC to an EOS, PBTC to EOS does. The same thing to Ethereum. The one thing I'm interested on EOS is like with Ethereum, you still have those block times. and you still have these times that the user functionality is still kind of like, and it's never going to get any better, correct? Like it's not going to get, in fact, it'll actually get worse. So with EOS though, what you have is wrapped BTC or some type of BBTC, and you're able to move BTC like instantly almost. So I wonder what that actually does to EOS from that perspective.
Yeah, and as you guys can tell, we're about to move into the EOS segment of the podcast. But you bring up an important point, because I forgot about this when talking about what Vitalik had mentioned in some of his comments around ETH 2.0. But he did mention that one thing they're planning on doing is instead of having a variable price mechanic where the fees on ETH will change based on network congestion, right? So in the case of the Maker exploit, right, there's so much congestion, nobody can get through. If you want to get a transaction through, that fee is essentially, for all purposes, jumped up way high, right? If you want to push a transaction through, you got to spend 100, 150, $200. And when you look to scale this out to other applications or other product or service use cases, that becomes a real problem because you don't have a set fee. So he mentioned that they were going to move from a variable fee structure to an actual variable block size structure where the fee would stay within maybe, say, a tight range, but the block size would be more dynamic, so that as the market started to get more congested, the block size would increase, thus allowing for more transactions and thus theoretically helping the congestion there. So I think they're working on some of those things, right? If I'm Vitalik, that's probably one of the biggest risks I see in folks finally washing their hands of ETH and saying, you know what, I can't do this anymore. There's too many security risks with this kind of DeFi. So I would imagine that's at the top of their list to at least try for a solution.
Yeah, one thing that comes to mind for me is that I think that this structure is actually way better for the back end for maybe perhaps companies that are looking to use certain transactions that need to be done, let's say in BTC, and they really need to settle it quickly, move it quickly, and so on. Where maybe for the regular user, it really doesn't matter. Like if the speed of BTC doesn't
because you're holding it essentially.
Yeah, exactly. I'm holding them. What am I going to transfer it to a friend? It's going to take like half an hour, whatever. I don't care. And maybe the fees, yeah. Okay. I mean, yeah, but then again, we pay fees using apps like Venmo and others, right? Like or something else. It's just for the convenience purpose, and we don't want to get tied into like setting up a whole bunch of stuff to be able to use these wrapped products. So I think it has a very good use case, but I think it's centered around companies that are going to need to do settlements quickly and going to push a lot of volume, right? Because if you push in a lot of volume and settlements happen, that's where the fees come into play. So I think it's a back end structure that's going to be used for the market rather than front-facing retail. That's going to be just that's going to pick up a lot of steam from them.
Yeah, those comments kind of echo what Mashinsky was saying when we had him on the podcast, where he was kind of saying, who's using DeFi? It's not like the average retail user that's using DeFi. So in that same light, the average Bitcoin holder, or your mom or your dad, is not going to go in and wrap their BTC and send it to EOS and move all this shit. So
exactly. Speaking of Mashinsky, actually.
Oh, there it is. The other plug.
Yep.
I like it, man. So, I mean, those are good comments. I think we had some comments in the chat. Scott's saying it was great for EOS. It was feeless Bitcoin transactions. Ethereum virtual machine optimistic parallel execution looks good in ETH 2.0. Finally, some good improvements. Give me faster verification times. I think he was talking about. That's a comment towards you, Mike, or your comments. So Kieran was also saying DeFi or get pwned every day fi. So. There is some interesting things going on, and we're happy to report them. We're happy to joke about them as well. Let's fly through this EOS news. We did have 4 pieces of EOS news. Block.One did win that patent for, I guess, like social media incentivizations and like positive feedbacks. I talked about this with Rob, your brother Mike, and he was kind of saying, so let me go through the story real quick. Basically, EOS or Block.One was able to get this patent and allow, let me see, and I'm making sure, a new bidding methodology to grant exposure to users other than the post's original author. So these are processes that are already going on within Voice right now. Basically, when somebody posts, not only the ethos around this is that not only the poster should be able to get recognition from that post. I don't know how much I agree with that, but basically you're gamifying the idea that someone posts something, they're obviously getting clout from posting it, they did the research, all this stuff, but also somebody can bid on being attached to that post. So basically, like, let's say Travis posted something on Twitter and he's getting the clout from obviously like posting about it, but you could go in there and bid Voice or bid tweet or whatever and get not only a monetary compensation, but at the end of it, you could get a clout for having upvoted that post or liked or retweeted that post. So this methodology, I guess, got patented. So, and I'll read it. Specifically, the system would first verify the authenticity of a post through a blockchain to make sure that the content is the original work of the author. Users wishing to be associated with the post could bid on it with tokens distributed by the social media platform. The highest bidder will have their profile displayed in a noticeable spot on the post. So this, it's good to point out this already exists on Voice, and they started this patent a year ago. So they're just patenting a process that they're actually just in the process of doing on Voice right now. The conversation I had with Rob was the fact that like that specific methodology where they run it through the blockchain and with all this KYC and authenticity, that's what's actually getting put into this this patent, right? Because like there's other social media platforms that already do this kind of stuff. It's just adding that blockchain and authenticity component.
Yeah, when you look at a patent, you if it's structured in a way that courts would deem a business method or a method of business, you have to have some what they call like non-standard computer functionality that it's backed by that makes it unique enough to patent. And I think we're going to see more and more of these patents come up as projects and teams realize like, oh, hey, I can take a quote unquote business method or some sort of method involved in my business and just put it on a blockchain and at least for some time get a patent. There's obviously a lot of value in having that when you know you're looking at competing with other blockchain based social media platforms or projects that are related to your space. So
yeah, but also at the same time, I feel like just in general patents are like kind of weak, you know, if you will, in terms of enforcing, let's say, you know, that nobody else does it, especially when, you know, when we live in global society where, you know, other countries, you know, if you start, you know, creating Voice and similar stuff in other country that really doesn't care about what patent you have in the US, then, you know, like, you know what I'm saying?
Got
like,
it.
There's really no difference there. But
yeah, the main story around this not only is the patent, it's just like whether their I guess thesis is correct in that this game theory around people getting paid not only to post, because again, people gain clout just from in respect through posting on Twitter. If you're knowledgeable and you post consistently, you're going to gain a following on Twitter. It's their thesis is you're trying to reward the actual participants, not only the one who is the author. So just reading directly from this, it says, all post data will be stored on a blockchain, and tokens obtained through the bidding process will be distributed to the author, a previous highest bidder, and the administrator. So there's just some game theory around incentivizing people to take part in social media. We'll see if it plays out for them. Voice has also made some other changes. I think they're limiting the amount of text on each post. They came out and kind of wanted to do this medium approach where they had an unlimited cap of text. And now I think just based on user feedback, they're going to a smaller text portion. Just little improvements like that. I think they're launching. They're still planning on launching like Q1 2021.
So I was going to ask, is there a way to like game this? You know, I understand this KYC, right? So what stops me from registering my grandma, my family, everybody on voice, and then just clicking, and clacking on their accounts and making all this stuff, right?
That's fair. One of the first posts on Voice that I saw was about a guy gaming Voice. He was like, I actually like got through their KYC process using fake accounts and yada.
Was
yada,
it Pete?
Yeah.
It might have been Pete. Pete, if it was you, comment on the section, dude. But
yeah, it'll be interesting. I mean, I think what they're doing is they're opening up the avenues between creators in a lot of ways. So in a typical Twitter or Reddit or anything else, right? It's kind of creator versus creator, especially if you're talking within, say, the same subreddit, right? So any upvotes that you get is, assuming those upvotes are finite, right? Some potential that I won't get those upvotes. But if now creators can say upvote some other creators' post, and in return their posts will be featured on Voice, assuming they do that enough, then what stops a bunch of creators from getting together and kind of creating this this sort of like cartel of sorts and saying, okay, well, every time one of us posts here, all of us are going to kind of take turns to having the largest number of upvotes so that then our next post is featured. And you end up only seeing the post from those folks who are kind of in the cool kids camp, if you will.
Or there would be like a black market.
There's so much game theory around it, right? There really is, and it's going to be interesting to see how it plays out. Block.One has like been historically like super closed about all their interviews and all their people. I know Ash works over at Block.One, and for like he's I don't want to say locked down, but there's no interviews that we could do with him or anybody at Block.One. They've been historically very, playing their cards close to the vest. So it would be interesting to hear straight from the horse's mouth what's going on at Voice and what's going on at Block.One, but we'll have to wait and see.
My people call this the Iron Curtain.
The regulatory curtain.
Yeah, exactly.
Yeah. So we'll see. We'll see where that goes. So we got EOSDT, and then I'll fly through the other two pieces of news before we finish at Ripple.
Yeah. So this is something we kind of touched on already from the east side. So EOSDT supply cap increased by 100 million with Bitcoin liquidity support. So now basically they released the BTC or PBTC basically that you can hold, which is going to be on EOS network, which gives you all the benefits of the EOS network by having PBTC, which is backed by essentially one BTC. It gives more flexibility and all of those things, and obviously that's kind of increasing the overall EOS DT market cap, which is now at 100 million. Well, actually, no, 100 million increase of the market cap in general. But also, they have over 11 million in terms of EOS collateral. That's what the Equilibrium, the company that's doing this, mentioned, that USDT smart contract holds more than 11 million of EOS collateral at the moment. So it's just the stuff that's happening here in the background of interoperability. I can't pronounce that word. On EOS. So
yeah, that's interesting. Scott's in the chat saying I already tried out PBTC to EOSDT and it works great. So all of these little interoperability sections I think do help EOS. And one of the things that we said while you were gone, Mike, was based on Mashinsky's comments that when we had him on the episode, it's like who's actually using all of these processes where you start to add layers of friction, right? Like what retail user is going to go into PBTC and then exchange it for some type of like DAI where he's now, staking ETH to get DAI. There's a lot of processes involved. So it will be interesting to see the users that come about and who's actually using all of these interoperable kind of financial processes and things like that. So. Yeah,
it seems to me it's only going to be the hardcore community members who only want to stay within the EOS ecosystem, right? So now you can get exposure to BTC via PBTC without, going and actually buying physical BTC on some exchange or some decentralized exchange. You can do it within the EOS ecosystem via say, a decentralized exchange there, move out of EOS into the stablecoin, but yeah, it's, how do you build a business model around that as a company trying to issue this, when the users there are so small? I think that's a difficult thing to do, versus if you look at like a Keep who's trying to bring BTC to ETH, there are many more users who hold BTC and want to have access to ETH's DeFi in a really, really, seamless way.
Yeah, that would be the long-term play. I think you're kind of like taking the long-term view of the EOS ecosystem will eventually grow out. This is kind of just building that stuff. And I do want to honestly say, like, this. Oh, Scott's in the chat telling me to move the arrow.
Calling you out.
This is all long-term stuff. I don't think like we're not like talking. I think we have to take the whole industry view, right? Like we never want to get like put into a box here. We appreciate all the networks that are doing work, and we're trying to be honest about the benefits and also the negatives that exist within each of those networks. So it is good to see all this stuff, but there is like, I feel like there is a situation where you need to grow a user base in order for this stuff to actually be kind of like useful at all. So, but if it's working for Scott, I mean, it's being useful. So the last two kind of stories here: major firm Grant Thornton innovates with EOS.io blockchain tech. Again, I don't want to get out of line here, so I need to say up front, like, they're just using EOS.io tech. They're not like building on the public blockchain, right? But this is a large firm that deals with in different industries. I think they have 1.7 billion in revenue last year. This is Grant Thornton International, and they deal with asset management, banking, manufacturing, telecommunication, transportation, technology. So they work in a ton of different industries, and they're, I guess, working on their back end to set up through EOS.io tech to make sure that all of their data infrastructure is built on this technology. So it's good to see that happening. It'll be interesting to see.
Bullish?
A little bit bullish. I mean, we've talked about kind of that situation where enterprises are using blockchain tech, and how does that benefit the actual token in the EOS ecosystem. But we'll see how that plays out here with EOS. So the only other thing, Graymass was a big, a big team within EOS as it first launched. They launched one of the first public voters for staking on EOS. So it allowed users to actually like vote with their EOS to different block producers. They actually came out with Anchor, the Anchor wallet recently. I think it's within the past week. So basically, there's another competitor to Scatter. And I think, honestly, we've been following Scatter for a long time. They've done great work, but it's good to see one of the longest like tenured teams within EOS put out their own wallet, this Anchor wallet. I haven't personally tried it. If any of you guys in the chat have, it'd be great to hear your comments on the functionality. It's going to work probably similarly to that desktop wallet that you see with Scatter if you've interacted with that. They're planning on launching a mobile wallet and things like that. The description actually has the link, and there was an interview done by EOS Writer to the Graymass team about the Anchor wallet, so you can hear a lot more about that wallet. But I plan on downloading that this week and kind of messing around with it, seeing how it works comparatively to Scatter.
Nice. Yeah, very cool. Well, moving on here, we're coming up on about 2 hours, so a longer Layer1Live than normal, but lots of news this week. We're going to finish up with Ripple here, like we talked about at the front of the episode. Some breaking news that we saw this morning from the block was that Ripple has supposedly paid over $16 million worth of XRP to MoneyGram. This is in the Q1 2020 period. In the form of incentives, right? So evidently, one of the reasons this partnership exists is so that MoneyGram can come into the Ripple network. It's again, very, to be clear here, right? It's not, it has nothing to do with the Ripple token, right? The Ripple kind of payment network that they're trying to, integrate with a variety of different banks all across the world. MoneyGram is helping them via their ODL, their on-demand liquidity platform, by providing basically liquidity and some other services to that platform. And MoneyGram is getting paid XRP by the company Ripple to provide that liquidity. Interesting point here is that in Q3 and Q4 of 2019, those incentives only totaled $11.3 million total. So in Q1 of 2020, you see that up about 50% when compared to, the total back half of 2019. I don't know if that, we obviously don't know what the structure of those incentives look like. Is it action based, where the more MoneyGram does, the more incentives they get? Is it going to continue increasing on a fixed kind of setup where next quarter Ripple will pay them $24 million in incentives? But this goes along the theme we've seen over the past few years of the company Ripple really moving away from the XRP token by dumping it on the market in one way or another. In this case, it's by giving it to MoneyGram and allowing them to dump it. The MoneyGram spokesperson told the Block earlier in 2020 that basically while they receive incentives in XRP, quote, "We sell XRP as soon as we receive it. We don't hold any XRP."
Right.
So if you kind of read through the lines a little bit here, it's basically Ripple utilizing someone else other than themselves to dump XRP and complete some sort of positive business action for the Ripple network. Obviously, the more XRP that Ripple dumps on the network, the more liability that they might have in doing so when there are markets that are actively selling XRP to say consumers who maybe don't fully understand the token versus the network setup, which takes me to the second point. Then I want to hear your guys' thoughts, but it came out that, of course, the co-founder, Jed McCaleb, sold 54 million XRP in April. He still has billions of Ripple of XRP left to sell, according to some of the activity around his wallet. He's been under the microscope for pushing XRP, the token, as something that isn't just a vehicle for them to pull cash out of. And when doing that, while at the same time dumping it on the market, you run into potential legal issues, depending on who's getting burned by him dumping those tokens. So it's it's classic Ripple here, really.
I like how remember that report that I posted in Layer1 chat from Ripple? It's a quarterly report, basically them saying, hey, we've actually stopped selling, XRP for, the whole, I think Q1. So everybody's like, oh, wow, look, Ripple is not selling XRP anymore. Here's the proof. And there's a pretty lengthy report there. But hey, guess what? Guess who is selling, right, XRP? And it's their partner, and then you have this guy who's, co-founder, obviously sitting on a lot of XRP as well. It's, they're just doing some creative things to show to the public, hey, they're not doing this stuff, which is true, right? They're not, right? But they are, in a way. So they're not lying, but they're not,
withholding the truth as well.
Yeah, exactly. But I like, this point about, so the co-founder, right? You also have to think about the other people that are holding significant amount of XRP, and one of them is actually the CTO of Stellar. Who holds a significant amount. He holds 4.7 billion as of February 2020. So there's other players that are going to be holding it as well, and I think they're not going to be. They're going to coordinate in terms of how they're going to unwind some of their positions, but the way it looks man, XRP has been really struggling.
Yeah, I don't want to get burned at the stake here, but it just seems like a well executed Ponzi scheme. If you're having the guy who created it continuously unloading. You're talking about, these are standard practices. I think in the article it says Ripple spokesperson said standard practices for any growing business. In payments, even established players continue to run robust incentive programs. The incentive program of money that they just produced out of thin air So
Right.
there does seem to be like those type of processes involved. I'm never been an investor in Ripple, nor will I mean, it's
Sketchy
tough to like,
territory.
yeah, it's tough to like really like lock down the definition of a Ponzi scheme. I guess if like you don't want to like classify something that's not a Ponzi scheme. Obviously, I feel like that's kind of like a bad mark to have. So maybe they're not a Ponzi scheme, but they're acting like it in a lot of ways. Like they're continuously producing something called business and also dumping all of this shit on retail, all the time. So I don't know.
Yeah, at some point, I feel like they're going to be in court trying to, back up a lot of their claims. And in general, it seems to me like when you're dealing with this, these projects get in trouble, not necessarily for what they're doing, but what they're not disclosing.
Mm-hmm.
So if some class action lawsuit comes out and says, hey, Ripple dumped from, 30 cents to 3 cents and I lost all my money, and I'm, some non-accredited investor, and oh, by the way, there's like 10,000 of me or whatever. Same stuff you see with Tezos, same stuff you see with EOS, just around obviously the sale. Then it's on Ripple to prove in a lot of ways how they've gone about letting people know, oh, hey, like the XRP token is different than the Ripple network. And I'm sure that's what their lawyers are saying. And when you have a lot of money, as Ripple does, it's hard to bet against them as the company. But to bet on the token, something that they're actively trying to get rid of, is just kind of it doesn't make sense, right? And I would imagine a lot of folks that were a part of that XRP army have moved on to other projects like a Tezos or like a Chainlink, where there's a lot more actual kind of utility and growth and action happening.
Yeah, they've been distancing themselves away from XRP for a while already. All the rhetoric that comes out is like, hey, listen, these are two different things, and we have nothing to do basically with XRP. We're Ripple, we're doing this stuff. Not to kind of beat that Ripple down a lot. Maybe there's some silver lining there in terms of how they're helping in terms of cross-border payments with the MoneyGram and so on. And if they make that process more efficient for MoneyGram, where it saves them money, maybe that gets passed along to the retail people that use that service in the end, and they benefit from that, right?
Dimitri's on payroll.
Maybe that could be, because listen, if they're making that market more efficient on more players are getting in, then that savings technically should trickle down to the regular people. And I think that's kind of why areas like Latin America is very big in terms of liking XRP a lot, because they obviously use cross-border payments quite a bit. So
boom.
Yeah. Makes sense. Well, that's what we got. Anything else before we let him go, Q?
We're trickling into almost 2 hours here. We're 1:58:40, so we're we're right under the 2 hour mark. Guys, another great Layer1Live episode. Everybody in the chat, Scott, 1-2, Kieran's in the chat, Andre was in the chat, Manuel was in the chat. We appreciate Meta was in the chat. We appreciate all you guys coming along and really participating in Layer1Live, man. It's definitely fun when you guys get involved. So we appreciate that. Telegram group going out today. If you get the invite, you're one of the cool kids. If you want an invite, message me. We'll see if we can invite you. Otherwise, this was a great episode, guys. You got anything before we head off?
Tomorrow, Dimitri's desk, 5 p.m.
Boom.
Boom.
Always be chilling. All right. Later, guys.